Hello everyone, my name's Elliot Gu, and I'm co-founder of Capitalist Times Investment Research and the Energy Bulletin. The mainstream and financial media, alongside many of my peers, frankly, in the financial newsletter business, have been jumping all over this Venezuela story over this past week. And I can't say I entirely blame them. I mean, the media is all about attracting attention and eyeballs, and this story has everything, right? You have the Russians, you have the Iranians, you have China, you have terrorists, you have drug trafficking, you have 21st century socialists, you have regular socialists and commies, you have espionage, you have Donald Trump, and you even have the elite Delta Force. No wonder the media is all over it. It sounds like a spy thriller I picked up in the airport back in 1989. It's a blend of the classic film Scarface and a Chuck Norris movie I think I might have watched back in the 80s. The media is selling you the villains, the special ops, and the big prize. But while you're watching the explosions and listening to the political narratives they're spinning, these very same media outlets are costing you a ton of cash. Over the past week alone, I've heard a lot of dangerous myths, half-truths, half-baked investment narratives, and frankly, fake news. Some of it is pushing individual investors to buy the wrong stocks, even into dangerous stocks, if you actually want to profit from real trends underway in energy markets, or if you just want to understand what impact recent events in Venezuela might have on oil and gasoline prices, and even the why. I'm talking about real economic reasons why the US may have acted in Venezuela. So let's break it down. 3 of the most expensive myths I've been hearing over the past week about energy markets and Venezuela, the truth, and some of the energy sectors that might actually benefit from all this. First up, myth number 1, a sludge no one wants. This one was brought to my attention early last week, and I followed up and found some quotes and stories in the mainstream media that I've thrown up here on your screen. The basic idea is that much of Venezuela's oil production and reserves is heavy sour crude. Now, the term heavy refers to the API gravity or density of the oil, but what it really means is that it's more difficult to refine, and not all refineries around the world can handle heavy or sour crude. Now, the sour part specifically refers to the sulfur content. Sulfur must be removed in the refining process to create usable products like gasoline and, imagine that, ultra-low sulfur diesel. The media narrative that Venezuelan oil is sludge or goop, I've heard, no one wants, is particularly dangerous and expensive because it actually has the potential to turn investors away from the one energy sector that probably stands to benefit most, at least in the short to intermediate term, from what's going on in Venezuela right now. Look at this chart. I pulled this monthly data from the Energy Information Administration, which of course is part of the US Department of Energy. Now the blue line here shows the price of West Texas Intermediate, or WTI crude oil. This is a US light sweet crude oil benchmark, while the orange line is a Mexican heavy sour crude oil benchmark known as Maya. The green columns below these lines show the price of Maya less the price of WTI. A negative number means that Maya is trading at a discount to WTI and vice versa. I took this chart back to January 2000, and you can clearly see that Maya usually trades at a discount to WTI for the very reasons I just outlined, including that many refineries around the world can't refine heavy sour grades of oil like Maya, and it's simply tougher to refine. Now here are the expensive missing links in the media narrative. First, US shale oil production is light sweet crude. Actually, much of it represents ultra light sweet crude. This chart, also from EIA, shows the percentage of US oil production from the lower 48 states, which includes, of course, the Permian Basin and most of the big shale plays in the US. And it's broken down by type, by API gravity. Oil with an API gravity less than 35 degrees is considered heavy or medium crude. Oil with an API gravity above 35 degrees is light and between 40 and 50 degrees is ultralight. Now when you get to that 50 degrees level, above that, it's mostly what's called condensate, which often exists actually as a gas underground, but turns into a liquid at surface pressures. It's a very, very light hydrocarbon product. So back in 2016, 2017, these heavier grades of oil, that's sub 35 degrees API gravity, that's the dark blue line, okay, they accounted for around 30% of US oil production, almost a third, falling under 20% by early 2024. These are the last months for which we have EIA data broken down like this. Meanwhile, light sweet crude oil is about 23.5% of US oil production, and ultralight a whopping 48.3%, up from less than 40% back in 2015. So light, ultralight, and condensate production represents upwards of 80% of US lower 48 oil production. The problem is that US refineries, particularly on the US Gulf Coast, are among the most complex in the world. And what that means is that they're capable of refining heavy and sour crude oil varieties. In fact, they're set up specifically to do so. And they just don't run efficiently unless they can mix all that light crude oil production with some of what the media is calling sludge. That's heavy sour crude. That's particularly true if they want to produce distillates, which include diesel fuel, heating oil, things like that. And distillate demand globally is actually growing faster than demand for gasoline. Take one more look at this chart. Do you see that red circle I've drawn? This is one of the few periods of time, this is back in late 2018 and early 2019, when Mexican Maya heavy crude oil actually traded at a premium price to WTI, to West Texas Intermediate. Now, if you remember that this was the time when Donald Trump put sanctions on Venezuelan oil imports into the US. So the media says Venezuelan oil is a white elephant that nobody wants. If that's true, explain 2019. When Venezuelan oil was sanctioned off the market in early 2019, the price of this so-called sludge actually spiked to a premium. Refiners were so desperate for it that they paid more for dirty, heavy oil than they did for clean Texas shale. You don't pay the premium for something you don't need. And look at what's happened here since 2023 or so. I put a little arrow there for you. A gradual decline in the Maya discount to WTI, the heavy sour crude oil discount. That's driven by a relative shortage of heavy oil on the US market. Now this chart only extends up to October 2025, which of course is before the recurrent, if you will, Venezuela windfall. By flooding the Gulf Coast with 40 to 50 million barrels of stored Venezuelan crude, and more to follow as production restarts here in January, the US is effectively ending the heavy drought. This increased supply will naturally push down the price of heavy crude oil relative to WTI, back to more normal levels, even lower. And select US refiners have been paying a premium just to get heavy crude, mainly from Canada, but also from places like Iraq. Switching back to cheap 4-day transit Venezuelan crude is like a massive pay raise for their bottom line. The media calls this a white elephant gift, but look at the spreads. Since 2023, refiners have been starving for more heavy crude. By unlocking Venezuela, it's boosting the profit margins for the refining industries. And that brings me to this, myth number 2, a $17 trillion treasure chest. So this is essentially the idea, repeated ad nauseum last week, that Venezuela has the largest proven oil reserves in the world, some 300 plus billion barrels of oil. And some, mainly social media posts, but also major media news outlets, have been talking up the value of this oil at today's prices. So here are some of the quotes I saw about that idea just last week. My favorite has to be the last one, about having Venezuela having enough oil to power the planet for decades. 3 big issues with this narrative, starting with this, the paper barrels. Now this chart is sourced from the Energy Institute's Statistical Review of World Energy 2025. This is the report that used to be published by BP. Energy Institute took it over a few years ago. And it shows the total reserves for 3 countries from 1980 to 2020. Venezuela is in blue, Saudi Arabia in green, and the US in orange. Up until 2010, Saudi Arabia had by far the world's largest proved reserves. However, somewhat magically, Venezuela's reserves more than tripled from less than 90 billion barrels in 2006 to over 296 billion barrels in 2010. Why did this happen? Well, let me tell you. Then President of Venezuela, Hugo Chavez, pushed to reclassify that Orinoco Belt heavy crude in Venezuela as proven reserves to gain geopolitical leverage and a larger OPEC quota. Chavez also likely hoped the Western media would simply repeat the 300 billion barrels figure and Venezuela's claim to hold the largest oil reserves in the world without asking too many complicated technical questions or diving into the functional and economic realities of oil production. So he appears to have succeeded in that regard anyway. Unlike US or European reserves, these numbers have never been independently audited. They are political reserves, not economic reserves. Simply put, these reserve estimates are self-reported by Venezuela's national oil company, PDVSA, which is owned by the state. To be fair, under the direction of Hugo Chavez, PDVSA did work with some foreign partners, including Russia's Rosneft and China's CNPC, on that reclassification work on heavy oil reserves in the Orinoco Belt to proven reserves. However, even in the late 2000s, with oil prices around $100 a barrel, Venezuela's paper reserves ploy was controversial, both here in the West and in OPEC. And it makes even less sense today at much lower oil prices, sub $60 a barrel. Second, what really matters, both in terms of national wealth and global oil supply and demand balances, isn't how much oil a country theoretically has in the ground, but the potential rate of production in barrels per day. And while Venezuela claims to have the largest oil reserves, it produces less than 1 million barrels per day. That's less than 1% of total global oil consumption. Even at its late 1990s level of production, this was immediately before Hugo Chavez was elected president and began gutting the nation's energy industry, Venezuela produced just over 3 million barrels per day, which at the time was about 4.7% of global oil supply, now less than 3%. In comparison, US reserves are allegedly less than 1/4 of Venezuela's. I think it's about 23% as big. Yet it's the world's largest oil producer, with the US having over 13 million barrels per day of production, some 14 times what Venezuela produces right now. Saudi Arabia has slightly lower reserves than Venezuela, allegedly, yet it produces over 10 million barrels per day and has capacity to produce about 12 million barrels per day. Canada, which ranks third to Venezuela and Saudi Arabia in total reserves, produces less than half what the US does on a barrels per day basis, despite much larger reserves. Third, reserves don't represent a pool of oil sitting there waiting to be pumped through a pipeline to market. Even if we accept Venezuela's dubious claim to have the world's largest reserves, it doesn't matter if there are 300 billion barrels in the ground if the cost to get them out is higher than the current market price, so you would lose money on every barrel. The media frames this as Trump seizing wealth. In reality, he's taking over an industry that requires $100 to $110 billion in investment just to get back to 2 million barrels a day or so. The media loves to talk about the 300 billion barrels because it makes for a great headline about oil wars, stolen riches, but they never mention that this number was a political invention by Hugo Chavez to look bigger than Saudi Arabia. Here's the truth. You can't eat reserves. Until someone writes a $100 billion check to fix the pipes and develop new projects in Venezuela, that 300 billion barrels is next to worthless. And that brings me to my final point. The political winners and losers trap. So some want to call Venezuela a game changer for the global energy markets. The energy story of the decade. Even I've heard the energy story of the 21st century that's completely reshaping the energy industry, the oil industry. Truth be told, I'm not even sure Venezuela is the energy story of the week, at least as it applies to investing in the space. Look, here are a few quotes I found from last week. Essentially, the conventional wisdom in the financial media seems to be that Chevron, symbol SVX, and ConocoPhillips, symbol COP, are the big winners from the US government's military action in Venezuela and the opening up of the country's energy sector to American investment. After all, Chevron is the only big American oil company that maintained a position in Venezuela after the Hugo Chavez government effectively nationalized the industry back in 2007. The company remains a minority partner in several Orinoco Belt oil projects and produces in the region of 200 to 250,000 barrels a day from Venezuela. ConocoPhillips withdrew from the country in 2007, unlike Chevron, but they have won multiple arbitration awards against Venezuela for seizing its assets. Now, these total some $12 billion in claims against Venezuela, including interest. So ConocoPhillips could re-enter the country and accept stakes in some projects as a sort of payback for the money that was seized back in 2007. ExxonMobil also had assets seized in 2007, but it hasn't won arbitrations on the scale Conoco has, and the company withdrew from Venezuela in 2007 and appears less interested in returning to invest there, especially given the fact they already have massive projects elsewhere, including neighboring Guyana, that they're running. So if you listen to the media, the Venezuela action was a huge windfall for Chevron and Conoco relative to ExxonMobil, symbol there is XOM. Well, let's assume that you are an absolute geopolitical analysis wizard, right? And you called the US action in Venezuela here in early January, back at the end of August. You saw it months ahead of time. You saw the future just as the US Navy began so-called kinetic strikes against Venezuelan boats suspected of carrying narcotics back in early September. The first one was, I think, September 1st or 2nd. So when you decided this, when you predicted this, you rushed out to buy the geopolitical winners, right? Chevron and ConocoPhillips, while selling the geopolitical losers, right? Like ExxonMobil. Well, here's how that worked out. As you can see, since the end of August, Chevron is up 1.3%, and ConocoPhillips is actually down slightly. This includes dividends paid. Meanwhile, the S&P 500 Energy Index is up about 4.9%. And the Venezuela loser, ExxonMobil, well, that's up more than 9.6%. ExxonMobil even beat the S&P 500 over an equivalent holding period, the S&P 500 up about 9%. So the geopolitical prediction wizard who called the US action there last summer was completely right, but massively underperformed. Both the broader market and the supposed Venezuela loser, ExxonMobil. Why? Well, the answer is pretty simple if you think about it, right? Venezuela just isn't that important. And it's not a major driver of investment returns for the big oil companies, despite what you may have heard in the mainstream media. Just ask yourself, if this were really the investment story of the decade, then why is Exxon performing so well? Despite what you may have heard, geopolitics really isn't the be-all and end-all of investing in energy. It's actually a sideshow. And in my experience, the real money is made by fading the geopolitical headlines, betting against them, and looking beyond the shallow, vacuous narratives you hear on TV. At this point, you might be wondering, if Venezuelan oil production is so low at less than 1 million barrels per day, if the 300 billion barrels claim is so overstated, a Hugo Chavez political ploy back in 2010, as I've outlined, and if it's going to take $100+ billion to get the Venezuelan oil production back to over 2 million barrels a day from less than 1 million right now, and going to take 3 to 5 years, probably more like 5 years, then why did President Trump and the US bother with capturing de facto President Nicolas Maduro while seeking a change in government in Venezuela last week? Well, there were probably some reasons that have nothing to do with oil, to be frank. However, let's step back for a moment and consider another narrative you probably heard last week. Now, I've been hearing some version of this one for years now. Here are just 4 recent quotes. The basic idea is that the world doesn't need Venezuelan crude or any new oil production projects for that matter, because we're transitioning to electric vehicles, EVs, and a renewable energy future. If that were true, then opening up Venezuela's oil industry makes little economic sense. However, it's all just a peak oil demand ivory tower myth. Just consider the International Energy Agency, the IEA, which is a huge proponent of the peak oil transition myths. They recently predicted that global oil demand in 2025 was 104.4 million barrels a day. That's up from their estimate of 103.8 million barrels per day for 2025, just back at the end of June. The European Union, the EU, the most aggressive green regulator in the world, recently blinked. The European Commission scrapped the 100% zero emissions mandate for all vehicles in the EU by 2035. The EU replaced that with a 90% target. So that may not seem like a lot, right? But this 10% loophole is much bigger than it seems, because car manufacturers, for example, can now keep selling internal combustion engines in Europe as long as they offset the remaining 10% of emissions using a number of methods such as biofuels or green steel credits. And China, which we've been told is beating the US in terms of green technologies like solar and is transitioning to renewables faster than the US, well, based on satellite data, China has built some 2.1 to 2.3 billion barrels of oil storage capacity, which is up from about 1.4 billion barrels back in 2015. And they filled that storage with as much as 1.5 billion barrels of crude, and they have a target of building that to actually 2 billion barrels of crude oil in storage or so. China's president has said, quote, "The energy rice bowl must be held in our own hands." So let me ask you this. If China is transitioning to EVs and renewables, then why build out 30% more total oil storage capacity than the US? And why stockpile billions of barrels of crude oil? Are we supposed to think China is just stupid? No, the reality is that China knows that oil isn't dying, and the EU just admitted the same by rolling back their EV mandates. Global oil demand is growing, and an accelerating global base decline rate, that's falling production from maturing fields, means that the world needs more oil, needs more new oil projects. Over the next few years, the current excess global oil supply that you've been hearing so much about and the $60 a barrel crude that you've been hearing so much about will seem like a pleasant dream of the good old days. China knows it, the Trump administration knows it, even the EU knows it. And while Venezuela won't add to global production near term, I believe that it could add desperately needed heavy oil production strategically located just next to the US Gulf Coast refiners by the end of this decade or in the early 2030s. Now, by then, the peak oil demand myth and renewable transition narratives will be foundering on the rocks of reality. So there you have it. In this video, I've covered a number of points, including don't buy the goop heavy oil myth. US refineries want this oil. It's a margin play, not a charity case. Ignore the 300 billion barrels hype. Reserves are political. Production is economic. It will cost $110 billion to make those reserves matter. Watch the winners. If you follow the geopolitical headlines, you underperformed Exxon and the S&P 500 Energy Index. The long game. This isn't about 2026. This isn't about this year. This isn't about next year. This is about 2029, 2030, when the world realizes peak oil was a myth and supply is actually tight. Thanks for listening. I hope you found this video useful. If you're watching this video on Substack or YouTube and enjoyed it, please hit that heart-shaped like button to help me out with the algorithm. And if you haven't done so already, you can subscribe to receive energy and market commentary both written and videos like this, via email 1 to 2 times per week, absolutely free, here on the Free Market Speculator and Energy Bulletin. And if you're interested in more detail and specific stock selections, I'm offering 60-day free trials to the paid tier of the service for a limited time via the link below. Again, thanks for listening. I hope you found this useful.